Hello YouTube, Herman Williams here again. Are you looking for a passive income investment? Are you thinking of investing in real estate? Well, stick around because today's Money Smarts lesson is on how to invest in real estate for passive income. First, let me acknowledge that there are probably hundreds of videos and even more books about how to make money in real estate. And some of them actually have useful information, but a lot of them are also just trying to sell you what they say is a proven strategy for making money in real estate. Now, I'm not knocking any of those methods, and I will admit that most of them will work for some people. I will further admit that my strategy will not work for everyone either, but I'm also not trying to sell you anything. A lot of the books and videos are about how to make money flipping houses, which is buying a house at a bargain price, making a few repairs or upgrades, and then selling it for a profit. Other books and videos talk about how you can buy properties without having any money, and some of these techniques can actually work if you have the knowledge, the contacts, and the intestinal fortitude to make it work. But that's not the type of real estate investing I want to talk about today. What I want to share with you is some sound fundamental practices that you can use to build a stream of passive income from investing in real estate. If done properly, real estate investing can be a good way to not only produce income, but also to build wealth. So let's start with the basics. If you want to invest in real estate using my method, you're going to need two things to get started: a decent credit score and money for a down payment. Like I said in the beginning, there are plenty of books and videos out there that will tell you you can invest in real estate without having good credit or cash for a down payment. If you're willing to do the things that they will tell you to do in order to secure a purchase, or if you're willing to take on some of the risk that comes with some of these plans, then go for it. But you better know what you're getting into, and most new investors don't realize what they're signing up for with some of these creative practices. Again, some of these tactics can actually work for some people. But back to step one of my plan. Whether you're planning to invest in real estate for income or you're thinking of buying a home for yourself, you need to manage your debt and credit score. The reason you need to do this is not just to increase your chances of getting approved for a loan, but because it also saves you money in interest costs and gets you the best rate possible, which will play a role in what that passive income stream looks like. You also need to manage your credit score for a variety of other reasons that can save you money. The minimum credit score you will need is 620, with the best rates coming with scores of 740 and above. If you need help improving your credit score, you may want to watch my videos on understanding your credit score and repairing your credit. The other thing you need to do in step one, which goes hand in hand with managing your credit score, is eliminating debt. One of the things mortgage lenders will look at is the amount of debt you have compared to the amount of income you have. This is known as your debt to income ratio, or your DTI. Most lenders like to see a DTI of 36% or less, with no more than 28% of that going towards a mortgage. However, some lenders will go as high as 43% DTI. But if you want the best rate, focus on increasing your credit score and decreasing your DTI. Paying down debt can help you in both of those areas. Once you have your debt and credit score in order, it is time to start saving for a down payment. According to LendingTree, in most cases, the minimum amount for an investment property down payment is 15%. However, they also state that the down payment you're actually required to pay is determined by several factors, including your credit score, DTI, the type of loan program, and the property type. To qualify for a 15% down payment for a conventional loan for a one-unit investment property, you will need at least a 700 credit score in most cases. One exception is if your DTI is equal to or less than 36%, in which case the minimum credit score required is 680. The down payment required for an investment property with 2 to 4 units is 25%. Prior to the financial crisis in 2008, you could buy properties with very little and in some cases zero money down. Up until that time, it was generally believed that housing values would always go up, so banks didn't feel like they were taking on that much extra risk by requiring a smaller down payment. Well, all that changed when the real estate bubble burst. One way to possibly get around that large down payment is to look at multiple unit investment properties like a duplex, threeplex, or a quad unit. Also, according to LendingTree, if you plan to buy a multi-unit investment property that will double as your primary residence, you may be eligible for a government-backed loan from the Federal Housing Administration, or FHA, or the U.S. Department of Veterans Affairs, or VA. You can borrow an FHA loan to buy investment properties with up to 4 units with as little as 3.5% down, provided you occupy one of the units as your main home. You may qualify for a VA loan on a 1 to 4 unit property with 0% down payment. However, one of the units must be used as your primary residence. So as you can see, if you can qualify for a VA loan, you can buy a multi-unit investment property with no money down. This can be a great opportunity for our veterans to get into real estate investing. If you can come up with that 15 to 25% down payment, but you are willing to live in one unit and rent out the rest, the entire purchase could qualify as your primary residence, and your down payment may only be 3% or possibly 0 if you qualify for a VA loan. Just remember that anything over 4 units is considered commercial property and would not qualify as a primary residence. 2 important factors to keep in mind if you decide to go this route. 1, if you put down less than 20%, the lender will likely require you to have primary mortgage insurance, or PMI. This could add a possibly significant amount to your monthly payment, so you will need to factor that in when calculating your cash flow. The second thing to keep in mind if you decide to live in one unit while you rent out the others is that you will be very close to your tenants. If something breaks in the middle of the night, they may come knocking on your door rather than waiting for normal business hours. Still, this can be a good way to get started in real estate investing if you can't come up with that large down payment. Just keep in mind that different lenders and different programs may have different requirements for how long you have to live in the property. If you say you're going to live in one of the units and you never move in, or if you don't meet the time requirements, this could constitute mortgage fraud. Also, you will still have to qualify for the loan on your own income, but your lender will most likely consider 75% of the expected rental income as part of your loan application. The 3 most common ways to come up with a down payment are: 1, to save the amount you need over time. However, depending on where you are starting from and how much you need, this could take a while. 2, instead of going through a traditional lender, you could try to arrange an owner financing deal with the seller. I will tell you though, these are not easy to come by, and you will likely to pay a higher interest rate, assuming you can get them to agree to the deal. A third possible option is that if you have at least 20% equity in your primary residence, you could take out a home equity loan or use the proceeds from a cash out refinance as down payment for the rental property. This is the method I used to purchase my first rental property. As you are working on your credit score and down payment plan, you also need to be doing some market research. This is where you start putting in some legwork. If you're looking to invest in single-family homes, don't just focus on the one house that is for sale. Look at the entire neighborhood and the surrounding area. Look at the condition of the overall neighborhood. Does it look like the neighbors take good care of their property? If the surrounding properties are not well maintained, property values for all homes in the area could begin to decline, or at least not rise as fast as other areas. As you do your legwork, carry a notebook or journal with you and write down the good, the bad, and the ugly for each house that you look at. When it comes to finding a good deal, be prepared to look at a lot of properties. It is not uncommon to look at 40 to 50 houses in order to find one or two that will cash flow properly. When I say it will cash flow properly, I mean it will produce a positive cash flow after all expenses are met. I'm going to leave a link in the description below to a rental property investment calculator that I think you will find very helpful. If the property will not produce a positive cash flow, then you shouldn't buy it. As a last resort, I might consider a property that will break even, but that would only be worth considering if I felt good about the appreciation rate for that property, meaning I expect the value to go up at a better than average rate. But now you're getting into speculation. One of the most important things to consider when you're crunching the numbers is what is the expected vacancy rate. Anytime your property is not rented, it is costing you money. Not only do you not have the positive cash flow for that month or months, but that also means you have to pay the mortgage and utilities out of your pocket. I will also leave a link in the description to a site where you can find national and state vacancy rates and trends. But probably the best way to get the most accurate data for your area is to talk to property management companies or other landlords. This is a statistic that they keep up with regularly, and it is one that you should get familiar with as well. Another thing that property managers can possibly help you estimate is average maintenance costs. Now, some of this will be related to the quality of tenants, but some of it will also be a result of normal wear and tear and the age of the home. Either way, you need to be able to plug in a realistic number into your calculator to determine cash flow. As you assess each property, think about what you can do to tenant-proof your investment. Actually, there is no way to tenant-proof a rental property, but there are some things you can do to minimize some of the maintenance costs. One of the most common recurring costs of rental property is carpet. Some people think they are saving money by putting in cheap carpet, but carpet is just a dirt trap. And if you are having to replace the carpet every time you replace your tenants, the long-term cost is probably more than you think. Instead, I like to use as much ceramic tile and durable laminate as possible. That way I may have to do some floor cleaning between tenants, but not floor replacement. It may cost a little more up front, but it will save you money in the long run. Speaking of upfront costs, the other thing you need to note in your journal is what repairs or upgrades would need to be made to each property. Pay special attention to things like the condition and age of the roof, HVAC, plumbing, and electrical systems. These can be high-cost repairs and could easily turn a low-profit deal into a losing proposition. One not-so-expensive thing you can do to increase the rental value and possibly the resale value is to upgrade lighting and plumbing fixtures if they are outdated. If you have some basic handyman skills, you can do most of this yourself. You also want to note the type of structure of the house. I prefer brick, vinyl, or a combination of both. Wood frame houses are high maintenance and costly to keep up, so try to avoid those if you can. Once you get used to using the investment calculator and plugging in the respective numbers for each property, you will start to get a feel for the type of property that is best for you. Something else to consider when you're crunching the numbers is whether or not you will be using a property management company to manage your property. Property management fees can range from 4 to 12% of the monthly rent. However, you can usually negotiate a lower fee if they are managing multiple properties for you. The calculator in the link that I am providing also has a line item for this fee. Once you know how much you can afford to spend on the purchase, it is now time to get pre-approved. Before you go to the bank, you need to get some documents together to save yourself some time. You will likely need your last 2 years' tax returns. You will need proof of employment, and oh, by the way, banks like to see that you have been employed for at least 2 years. You will need recent bank statements if you are applying at a bank other than where your accounts are, and you will need proof of all sources of income that you want the bank to consider for your DTI. A word of warning here. If you have large amounts of cash income, you better be able to prove that it came from legitimate sources. For some reason, banks don't want to be involved in any money laundering schemes. Go figure. They may also ask you to show the sources of your down payment. I know some people have used their credit cards to finance their down payment, but as a financial advisor, I strongly advise you not do that for a whole host of reasons. One reason this is a bad idea is that if you are borderline on your DTI and you try to use credit cards to come up with the down payment, you may have just pushed your DTI over the threshold and disqualified yourself for the loan. Another reason this is a bad idea is because when people do this, they are usually accessing the cash advance feature on their credit card, and cash advances charge a higher interest rate than regular purchases. Also know what your credit score is when you apply, and if you can print it out and take it with you, all the better. Show them your latest credit score and ask them not to run your credit as a hard inquiry, because doing so will lower your credit score slightly. They may still do it before you actually close on the loan, but at that point it won't matter as much. Once you are pre-approved, you are ready to start making offers. Now don't get too anxious at this point, or you may end up paying too much for that first purchase. Using the investment calculator tool, decide on a cash flow range that you want to be in and stick to it. Make your offers based on staying in that range. Be prepared to evaluate 40 to 50 deals, make 8 to 10 offers, and maybe have one accepted. If the deal is not right, walk away and move on to the next one. Once you have the first deal under your belt, you can start planning for the next one. If you have been diligent in the process and found a property with a good cash flow, you can then use some or all of that cash flow to save for your next down payment. This is how you begin to build wealth through real estate investing. Right now may be a good time to start planning your real estate investment strategy. Vacancy rates are still trending down and interest rates are at an all-time low. The economic impacts of COVID-19 may also create some buying opportunities soon that didn't previously exist. So start now getting your finances together so that you will be ready to strike when the right deal comes along. Set your goals and then set your behaviors to meet your goals. As I always say, changing your behaviors can change your life. So until next time, behave well.